Gold rebounds after sharp correction. U.S. ISM manufacturing PMI awaited.
Euro-pound holds steady as traders stay sidelined ahead of Bank of England and ECB meetings. U.S. stocks may see early weakness as Nvidia slumps. Yen 2026 could be year of yen, HSBC.
Warsh-led boost limits. Dollar's weekly losses.
Bay Street likely to see wild swings. It's a good week to put the focus back on the macroeconomy.
Pound rally paused ahead of BOE, DBS. Brent. Oil prices surge amid geopolitical tensions. Deutsche Bank. Poland manufacturing downturn eases in January. Commodity-led sell-off in global markets. Scotia puts the silver route into context and highlights huge opportunity for miners. Silver price declines on U.S. policy shift, easing geopolitical tensions. Australian dollar, RBA expected to hike rates. TD Securities.
Four minutes. Yeah! Two-minute warning. Canada S&P Global Manufacturing PMI increased to 50.4 in January from previous 48.6.
Trump launches $12 billion minerals stockpile to boost U.S. manufacturing, counter China.
Yep. All right. Let's get to going. How much time's on the timer? Oh, none. Well, then it's definitely time. Kill the music. So welcome everybody to Forex.Today, the YouTube community of more than 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance, because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, so please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Let's go! So yo, how you doing? Huh? You looking good? Too much? Good morning! Hey, it's cold outside, but cheer up, it's going to get warmer. So what are we going to do today? Well, we're going to do technical and fundamental analysis. But I thought we'd talk about gold, oil, Bitcoin, and Warsh. What do you think about that? But welcome to my office. If I don't know you, my name is Wayne. It's really nice to meet you. So we got big moves in the markets. Biggest move, one-day move ever in silver on Friday. Bitcoin used to be 90, now it's 75. Yeah, that's a big change. Stock markets are down. Yep. Silver was 110. It dropped to 80. Yeah. Well, yeah. So, holy smokes. Lots of volatility. But I will remind you, it's not unusual for January. In fact, it's quite normal. So I hope you were not blindsided. Now, dropping 26% in one day is not normal, but a risk-off tone is normal. But what is actually going on? Bloomberg has been reporting that the big drop in gold and silver and Bitcoin has to do with over-leveraged Chinese traders. That might be somewhat true. I don't think it's the complete story at all, not even close. I think some of these alternative assets, whether it's gold, silver, or Bitcoin, had a lot to do with people very worried about the U.S. dollar, very worried about the independence of the Fed, very worried that Trump was going to put a puppet like Myron in charge of the Fed, and that the Fed would lose independence. And that's it. That's the demise of the dollar. Convert your dollar into Bitcoin, convert your dollar into gold, and yada. So on Friday, right before all these crashes, guess what? It was announced that President Trump is nominating Warsh. Oh. And then there was this massive move in the markets. I believe all of it occurred because Warsh is a good pick, and it preserves the independence of the Fed. and that he is not Trump's puppet boy to print money or to make money cheap. And so it's a huge sigh of relief. And the assets that were overvalued have been repriced based on it's not the end of the Fed. It's a good choice. He was very involved in responding to the 2008 financial crisis. He didn't like quantitative easing. He doesn't like mission creep. He doesn't like the Fed looking backwards and being slow. Because remember, they kept interest rates zero for way too long, years too long. And then they jacked interest rates all the way to 10%, because guess what? It was partially that the old policy partially created inflation. And then the Fed left it there, even though inflation's normalizing. They left it there a very long time, well above the neutral rate. And Worse was against that. He's like, dude, you need to normalize. And so I hear conflicting things about who he was and what he did before all of this in the media. And a lot of times they're like, well, he contradicts himself. No. The Fed was slow to raise interest rates. He said you need to use forward guidance. And then they were slow to cut interest rates, and he said you need to use forward guidance. But the media doesn't understand this because they're journalists, so they just say, well, he contradicts himself. He said you need to raise, and then he said you need to cut. So anyways, dude, actually, I think he was the best pick that could have been made. And he was also considered for Secretary of the Treasury, which went to Scott Bessent. Bessent's a Wall Street guy. Warsh is kind of a Wall Street guy, but he was very, very young. He's still very, very young, meaning I think he worked for Morgan Stanley for a couple of years and then went into public service, right? So I don't know if he's that like Bessent, definitely, right? But the thing is, they're both money guys, not necessarily professional politicians, right? They seem to know what is actually going on in Wall Street and financing and global macro. So I think it worked out really well. And so this big crash in gold, the big crash in silver, the big crash in Bitcoin, I think is because it was good news. So anyways, bravo, bravissimo. So people were worried that President Trump would put in a puppet and the Fed would lose its independence, and that absolutely did not happen. Cool. Good. Das ist gut, ja. Das ist gut. And, look at that. Things have improved even in the last couple of hours. Good. Good. This was a 12er, a negative 12er. Now it's a negative 10er. Hey, it's bad, but it was worse. Yep. Hey, man, it was worse. So things have improved just in the last couple hours. So that's good to know. Especially if you're trying to decide what are you going to do, buy a dip. Do you want to buy a dip in Bitcoin? Buy it at 75. Do you want to buy a dip in gold? Do you want to buy what? You want to buy something? Well, if you're trying to figure that out, instead of just pure charts, you can use our seasonality to know what is normal for direction. You can use our trend radars to help you decide when to pull the trigger. Is anybody interested in buying a dip in gold? Maybe not today, maybe not now, but in general, is anybody, if it comes back around, is anyone going to buy gold? Is anyone going to buy silver in the next, let's say, few days if the opportunity presents itself? Anyone going to take a big giant leap of faith? I'll just show you how to use TRADARS to time that purchase. Yeah, maybe he's not very committal. Honey, I love you. You're the love of my life. I want to spend the rest of my life with you. Will you marry me? Maybe. Possibly. I don't know. Let's see your credit score. Do you like pina coladas? So, okay, let's just pretend it's yes. You guys are so funny. Well, the first thing we could do, I guess, before I even get into the technical side of it is like, well, what does gold do? Let's just update ourselves. Okay. Yeah, December to February. Oh, so we just hit February. Check this out. The best time to buy gold is between December and February. Hey, did we get to the last day of January and gold collapsed on profit taking? That's interesting, huh? The worst time to buy gold is May to July. Most reliable bullish month for gold is January, with a 70% win rate over the last 20 years. No, sorry, over the last 10 years. So we had a massive month for gold in the month of January. On the last day, people took profit. Is anybody having an aha moment? January to February is actually mostly a down, and then March is good. So somewhere in February is a dip. Here we go. So we're in February now. We expect a slight loss. Okay. Now, here's the thing. You look at the vol. The vol is very high. So what this implies is that this is from the beginning of the month to the end of the month. But you could be -5 and close the month at -1, and it would still be true. So what we want to think is, okay, what is March like? March is a good month for gold. Oh. So we kind of want to see in the first couple of weeks this decline. And then you use technical analysis to buy, and then you can hold all the way through March. Historical data shows gold typically recovers in March after February weakness, with an average improvement of 6%. So if you could buy it -5, and then it does go up which would be historically normal 80% of the time, and it goes from -5 to +5, then you're doing pretty well. It's saying the normal Feb to March is closer to 6%, right? Cool. So somewhere between 6 and 10%. So we know we want February to be down so we can buy it. Does that make sense? Good. Well, that's actually that's actually a lot of data. So you need this entire table to make these discern. Okay. So we're looking at 5-year, 5-year median, 5-year percentage, 5-year standard deviation, 20-year average return. There's a lot of data going into this. And so then you go to something like trend. And you say, is this the time to buy? It's a dip? Yep. It's even a drop? Yeah. So we wanted the 5% decline, which is the lowest low in the deviation from the average. Okay. So when you calculate the standard deviation of all Februaries, sort of the most extreme is -5. The most extreme is +5. And we've had that now, haven't we? We're definitely low. In fact, we're much lower than normal. So now you want to use a tool like this and say, well, when does it turn bullish? And when you see this, and it updates, you can just sit on this now for the rest of the day. If you're waiting for gold, you might say, well, when the day trade goes from -18 to a positive integer, another fancy way of saying it is when the day trade turns green, you'll buy a dip on the scalp, and that's it. Now you're done. Now you wait. And you also know to hold it at least 6 weeks. But you better use a stop loss because, well, we got a very unusual volatility. Down is not unusual. Down 20% is unusual. But I'm just wondering if all the turmoil's over now. We've hit all the stops. Everyone that's going to be liquidated was taken out. All the dumb money is gone, and we go back to doing something smart. We're less worried about the Fed. We're more optimistic about the future. Like Warsh, for example, thinks the U.S. government has too much debt. This is what he blames on quantitative easing. He believes quantitative easing 1, 2, 3, 4 twist, and then the quantitative easing done during COVID is a giant bailout program for the U.S. government, which just piles on debt and gives the green light to government to just spend like the money is free. Unlimited amounts of money, free forever. Which he's like, dude, that is not true. So he's against quantitative easing. He's against out of control government spending. He's against overregulation of the banks, but he's also against bailing them out. So the future's good. Neat, huh? So anyways, so if you were going to buy this, you could just sit there. Now you can say, well, I did the whole same thing on silver, Wayne. Good. Well, it's scalp long, but day and swing short. You'd be too early. Yes, you're buying a dip, but you're buying a dip in a downtrend. Shouldn't you buy a dip in an uptrend? Yes, of course. Copper is actually flat. Look at the long term on copper. Cool. Now, this only looks back a couple of days. So our swing trade only looks back like 48 hours. You're like, but copper crashed 8 days ago. Yeah, well, this shows that it's no longer crashing. It moved first. You could say, well, Wayne, I want to buy the S&P 500 or NASDAQ. Okay, well, we can look at NASDAQ. And maybe, you might be right. It might be today, but it could be tomorrow. But you could sit here and wait for the slope, for the scalp to turn from negative to positive before you get going. Because for that to happen, you're going to need, it's going to create a higher high, and then you want to buy a dip, right? A higher low. And ideally, you're riding the upper part of the mean. What a fun animation. That's a fun animation. How fun. So anyways, wait for the red, right? Wait for this to turn green and then go to your charts. You might be early now. Isn't that nice? Yeah, it's very nice. Okay, we've added a lot of crypto. Crypto. Look at that. Look at, oh, the crypto. And just for the sake of transparency, we've added all our analysis for this page, right? Step 1, step 2, step 3, step 4, step 5, right? We put everything here so you know precisely why we say neutral and not bullish, or precisely bearish, not something else, right? I love the transparency. Love the transparency. Yeah. Trying to post, but YouTube doesn't let you post that much. So this is what I taught Aiden. Isn't that cool? We had COT come out. There were pretty significant flows. I already covered it this morning with the team at traders.com. So you're welcome to attend those. You have to subscribe, of course. But a lot of flow into dollar. But that's as of Tuesday. That's the reporting date for that. So it's not old data. It's the most new data. This data was released late on Friday afternoon, and the data was collected Tuesday night. And so this is the latest day of the data for the CFTC. We have it for bonds, commodities, stock indices, crypto futures, right? And Forex as well. So pound Swissy, if you looked at this, you would assume up. Dollar Swissy up, Aussie Swissy up. Okay. And in order. So CAD Swissy up a little bit, Swissy yen up a little bit more, Aussie Swissy more than that. Don't do Kiwi! Dollar Swissy up quite a bit, and pound Swissy up quite a bit. That's what it was suggesting. And of course, this is only the change in these capital stocks week over week by institutional investors as defined by like hedge fund managers, asset managers. I think inside of asset manager, you get like pension funds and maybe even insurance companies. Is there, right? So this week is all about jobs. We have JOLTS. We have ADP. We have initial jobless claims. We have non-farm payrolls headline and the unemployment all coming out this week. And of course, we have all this data for you to review whenever you want. And these dotted lines are our future guidance. Yeah. Average hourly earnings, we actually do to track for inflation. Those are our wages. A lot of movement in the bond market, or treasury market, I should say. Lots of moves in the treasury yields. Here's our beautiful charts. Bearish opportunity, bearish opportunity, bearish opportunity, bearish opportunity, bullish opportunity, and bearish. It needs to roll over now, dude. But yeah, an opportunity, bullish, and so we looked at that where it looked like money went into dollar and out of Swissy, but right here they both look weak. So there's a slightly positive slope here. Okay, and you can see we've had a lot of volatility lately. So this opportunity, it all works. It's just not very good. Because I can see our projections in the future. Yeah. So I'm like, I don't know, that doesn't look that great. But that looks way better for a bear. That looks way better for a bull. That looks like last chance, but we're in. Yeah, see, actually, it's warning you here. We're bears, but we're in the profit zone already. You should probably have already taken profit. The next leg is down maybe S3. So that's what that little green warning is like, dude, you should probably actually be out. On the day trade, now, the swing trade, you can just switch over to swing. We have a swing radar. We have a position radar. These are just day trades. So dollar strength, yen strength? Huh. Dollar strength. There's our target, M1. It makes sense. Dollar strength. Bounce off there. Yep. M4, that makes sense. We should be able to get there by the end of the day. So it all makes sense. Let's see if he's doing these other pairs yet. Looks like he might actually try. I think they're just going to pull up dollar. But I'm working on being able for you to basically create, in your mind at least, currency indices. Like look at Aussie versus everything, look for congruency, and basically say, if there was an Aussie index, it would be up now or down now, or something like that. Thank you, Adam. Now, I don't have aid and track U.S. manufacturing. Many reasons. One of them is we're not really a manufacturing economy, although we're trying to become more of one. So we could track services more, but I just decided not to use it. Like, is it a form of productivity? Is it a form of labor? Is it like, what is it that we actually care about inside of that? Labor demand, labor cost. And I decided we just have enough data when we look at the core the core of GDP change, which is year over year percentage change, monthly percentage change year over year, which is fantastic because you can go to the Fed and they have probably 25 different variations of GDP. What they don't have is this. There's nowhere in the Fed that says GDP is 4.4 in the United States. Isn't it strange? So you have to do all these calculations. But anyway, so I care about GDP for everybody. I care about CPI because not every country has PCE. And I could use wholesale, but we can care about the consumer. So even though I don't love CPI across the board, the actual central bank interest rate, the actual unemployment rate, trade balance of money going in and out of the economy. And then since we have the data, what are institutional investors doing? Are they investing into the dollar or out of the dollar? Okay. Long term, short term. And we do that for everything. So therefore, I'm like, that's enough fundamentally. Now, there are some other things like technical analysis that I've added to this, not on this page, but in something else I'm building right now. But long story short, we don't need anything more than this, right? Plus charts and seasonality. But those are different types of fundamentals, right? And so at the end of the day, ISM anything just didn't make it. ISM services and ISM manufacturing just didn't make it. So what it's not likely in like our spike radar because of that.
ISM manufacturing PMI registered at 52.6 above expectations, 48.5 in January.
U.S. January ISM manufacturing index 52.6 United States versus 48.5 expected. Emerging markets strong start in 2026 HSBC.
Market turbulence. United States Tesla tumbles while Oracle soars. January final U.S. S&P Global Manufacturing PMI 52.4 versus 51.9 prelim. United States S&P Global Manufacturing PMI came in at 52.4, above forecasts 51.9
Unless I have
in January.
It going somewhere else, I don't think Trump launches $12 billion minerals stockpile to boost U.S. manufacturing, counter China. It's my squawk box. Do I have it going somewhere else? No, new bug, huh? It's a new bug. It plays even though it's muted, and I can't mute it. All right, we'll get that. But we have enough to make a decision, I guess, is what I'm saying. And the other thing is, we want to be able to compare apples to apples across the board. So TDMI shouldn't be here because we don't have such a thing in the United States or the UK or somewhere else. We just want CPI. So this got on the calendar because Aiden looked at the calendar and saw inflation and said, "Ooh, we're tracking inflation." So I have to delete that and say, not this one. But interest rates coming out in 12 hours, do we care about that? Yeah. Oh, yeah, we do. What about Kiwi jobs? Yep. Moves 30 pips. What about UK CPI? Moves 18 pips. What about Euro and CPI? Actually, it doesn't move the market much at all, but we probably don't have enough data. Okay. The RBA interest rate decision, 54 pips. Isn't that nice? Bank of England in 3 days, 27 pips is what it's worth to you. We measured it twice, apparently, and got the same thing twice. ECB interest rate decision moves 51 pips, but it moves euro yen, euro dollar, and DAX. Jobless claims coming out on Thursday. Okay. Swedish inflation, yeah. I am Swedish, yeah. And then out there's our NFP unemployment. So I'm working on this. I'm just not working on it now. I know it's a little chunky and a little empty and a little bunch of things, but it's built. So I like swing trading. And so I like these. This is where I live. Mm-hmm. So I'm hoping today is a good day in the markets, that today is a recovery day. Okay. The NASDAQ can make it to monthly R2, the February R2. Huh? Wouldn't that be cool? I'd like Dow to get back to 50K. That would be nice. Dow 50K? Why not? That'd be good. So these are our swing plans for the stock indices around the world. We're actually bearish on Germany, and we're in the sell zone. So it really would be interesting now if it starts going higher. What happens is, like, this is a bullish by a dip, only because of this slope is positive, but 60% of this analysis by Aiden is fundamental. So this is a chunky, messy, dirty, yucky trade where nothing lines up, huh? This is much better. This is much better. This is much better. This is much better. Yeah, Liam, I spoke about it right at the beginning of the webinar. So rewind it to the right. Do a little rewind, and I specifically speak about it. Yeah, it's good in summary. Does it change much? Yeah, not dramatically, and not on the short run. What people were worried about is Trump would appoint a puppet that goes in and slashes and burns interest rates. Now, it's very difficult to do because it's a committee and not one person. But this is what people were worried about. But people are worried about a lot of things. And I don't know why. Yeah. But this idea that the Fed would lose its independence was a big deal. Yes. No. And it could have been. Like if you look at Myron or whatever the heck his name is, he is a puppet. There's no doubt he's a knuckle case. He's a knucklehead. You know, everyone's like, well, if we're going to cut interest rates maybe 1 or 2 more times. He's like, 10 more times. You're like, dude, it'd be negative. Cut negative. You're like, dude, you're a knucklehead. So that guy's a knucklehead. And so if he had picked somebody like Myron, the Fed would have definitely been like in the category of losing independence, for sure. But Warsh is great. So I actually am quite happy. I think he'll, and remember, I'm a capitalist, so these are my opinions in the sense that the Fed regulates the banks, but he believes over-regulates the bank. Now you might say, well, that's just, policy for the rich by the blah, blah, blah. Well, I don't subscribe to any of that. But the bottom line is he's also a fan of if you regulate but not over-regulate a bank, if they start making mistakes culturally, like they start just leveraging up and making bad loans and stuff, they should go out of business. Too big to fail? Fail. If you're too stupid to succeed, then you deserve to fail. But you don't need the government to make every single decision for you. So, so I don't think he's going to slash and burn regulations, but I think he's going to normalize. And when I say this, I work in the finance industry. I know lots of people in my life that are regulated in the finance industry. And it's extraordinarily overregulated. And people that work in the industry have fear. Every time a document has to be signed, it's terrifying. So that's not good. So if he can normalize that, that'd be great. I think quantitative easing was dangerous. The other thing that he champions that I didn't talk about before was he feels like the U.S. government and the central bank need to communicate to each other more, and that during COVID, where the government added $5 trillion of support and the Fed added $5 trillion of support, that they overlapped each other just because they had no idea what the other one was doing. And so did the Fed need to issue $5 trillion in credit when the government was issuing $5 trillion in cash? So I'm like, wait, I agree with that. Okay. Plus, he got his bachelor's degree from Stanford. Stanford's a great school. It's not an Ivy League, but it's pretty close. I used to hang out in Palo Alto all the time, man. My first Forex book I ever bought was from the Stanford University Library because Barnes & Noble didn't have any books on Forex, and Amazon.com hadn't been created yet. So anyways, so Stanford, then he goes to Harvard Law School, gets his law degree there, cum laude, which is what I got as well, which means you're an A- student. You're not the smartest person there, but you are no slouch, which means you're a hard worker, you're tough, you get stuff done no matter what. You're sick, F you, get your work done. Oh, it's vacation? F you, get your work done. Oh, the weather's nice? F you, get your work done. Oh, you didn't sleep enough? F you, get your work done. So he came out cum laude. This guy's tough. He gets his work done. And then he did some stuff at MIT like I did, and then he went somewhere else. I can't remember, another fancy pants school. So he's educated up the yin yang, but he grew up in upstate New York, rural New York, not New York City. So maybe some common sense is the idea. I don't think he grew up rich or anything, but he knows. I mean, if you study his career, not only is he a smart dude, but I don't know how he got these jobs. Like, he is good at networking and playing the game. So he's up, and even now, always the youngest guy in the room. He's smart, he's focused, he's driven, but somehow he gets on the Presidential Council of Economic Advisors, and he's only 33 years old. You're like, then he's the youngest governor ever appointed to the Fed in history? Like, dude, he was 36 and he's a governor, not a Fed president. He's on the board of governors. Why? Because he was appointed by President Bush, because he was the only one with common sense on the Economic Advisory Board. Like, how does he do it? So clearly got something, but is he a puppet? No. Is he going to fight for a strong Fed? Yeah. Is he going to slash and burn interest rates just because that's what the president wants? No. But he'll normalize it because he thinks the Fed's been too slow for years and years and years and years, going all the way back to Bernanke, that they're using old, dated models that are inaccurate, they're slow, they're not using artificial intelligence, they're still calling people, hey, do you have a job? You know, this kind of stuff. So he's like, dude. Now, of course, the Fed doesn't call people. That's the Bureau of Labor Statistics. But my point is, he believes the way the Fed goes about doing things and making decisions is old and outdated. And maybe it's because he's younger than everybody else. So he would have raised interest rates faster. He would have cut interest rates faster. The Fed's too slow because it looks backwards all the time. So it's always 6 months to a year late. Sometimes it's 3 years late. So cool. I'm okay with them. Worse, I think, is probably needed. A change in culture, but not to bend to the will of the President of the United States, but to do its job better. I'm okay with that. So anyway, didn't mean to go into yet another speech, but it does matter, Leon. Yeah, it does matter. So anyways,